What happens when Wall Street's most trusted banks start turning their backs on U.S. Treasury bonds? This isn't just a shift, it's a warning shot. Stay with us until the end because the cracks in America's financial foundation are spreading, and no one is safe. In this video, we dive into the dramatic retreat of major financial institutions from U.S. government debt. You'll discover why key players like Citadel Securities and JPMorgan are reducing their holdings, what this means for the stability of the global financial system, and why even foreign powers like China and Japan are pulling back. We'll explore how these moves could ignite a global shift in economic power, destabilize the dollar, and force the U.S. into dangerous territory, including the possibility of central banks losing control. By the end, you'll understand why gold is rising, why inflation may be intentional, and what happens when artificial intelligence begins setting the terms of America's credit. For years, a leading Wall Street institution treated U.S. Treasury bonds like popcorn at the movies, consumed in massive amounts without a second thought. But now, something has changed. Abruptly and publicly, this institution has paused its buying spree and reversed course. We're not talking about a subtle portfolio adjustment, we're talking about billions in long-term government debt being dumped. The message? Loud and clear. Trust in America's sovereign debt is eroding. That shift should make everyone pause. What does it mean when institutions once seen as the backbone of the U.S. financial system begin walking away from the very instruments they helped uphold? It's time to move past assumptions, step out of the comfort zone, and face the hard truth. Because if banks no longer want treasuries, who will? This decision may be the first domino in a much darker chain reaction, one Washington can't afford to ignore. Citadel Securities, one of the most advanced liquidity providers on Wall Street, has slashed its exposure to long-term U.S. debt by billions. And this isn't a fringe hedge fund making a speculative bet. It's a core player sending a signal. Long-duration bonds now carry disproportionate risk. In plain terms, debt once deemed untouchable is now structurally uncertain. But why now? The answer may lie in the recent chaos rippling through the bond market. Despite the 10-year yield surpassing 4.95%, the highest since 2007, primary dealers are struggling to offload their inventory. According to data from the New York Fed, dealer balance sheets now hold $340 billion in treasuries, the most since the COVID panic of 2020. This isn't a paradox. Rising yields coupled with dwindling demand is a red flag, and Wall Street just sent an unspoken message to Washington. You're on your own. But if one bank exits, what happens if they all do? In March, Treasury Secretary Scott Bessent introduced a proposal aimed at loosening Basel III capital requirements for banks holding government debt. The goal was clear: boost domestic credit and improve bond market liquidity. But not everyone was convinced. Daniel Tarullo, a former Federal Reserve governor, immediately sounded the alarm. In an op-ed published in the Wall Street Journal, he warned that this plan doesn't fix the underlying problem. It merely shifts sovereign risk into the banking sector. The mechanics may seem technical, but the implications are massive. By easing leverage ratios, banks would be allowed to accumulate more government debt without increasing their capital buffers. In simple terms, they'd be encouraged to absorb more risk without being any better prepared to handle losses. Moody's, which has already placed several institutions on negative watch, warned that this blurs the line between market intervention and outright fiscal rescue. And history shows that when risk is underestimated and hidden behind opaque accounting, consequences are never theoretical for long. Just ask anyone who remembers 2008. And yet one contradiction remains. Why deregulate to boost demand for an asset that's supposed to be risk-free? Not long ago, yields at these levels would have attracted institutional investors in droves. Today, those same banks are backing away from the very instruments that once built their balance sheets. In Q1 of 2025, JPMorgan reduced its exposure to treasuries by 11%, Bank of America by 8%, and Wells Fargo by 10%, according to 13F filings. Why the retreat?
In a rare moment of transparency, JPMorgan CEO Jamie Dimon addressed the issue in his April 2025 letter to shareholders. "We believe the market is underestimating long-term inflation expectations and that the Fed will need to tighten further." Translation: even at 5%, these yields may not be worth the risk. They could be value traps. And recent data seems to back that up. The core consumer price index, excluding food and energy, rose 0.6% in March, beating expectations for the third month in a row. On an annualized basis, that puts inflation at 4.2%, far above the Fed's 2% target, with no sign of slowing. Add to that America's ballooning budget deficits, projected to hit $1.8 trillion in fiscal year 2025, and suddenly Treasuries no longer look like a safe haven. They look more like a slow bleed. But if domestic banks won't absorb the risk and foreign buyers start retreating, who's left to keep the machine running? China and Japan, once the passive financiers of America's debt, are now becoming reluctant lenders. China's holdings of Treasuries fell to $767 billion in February 2025, down from $859 billion a year earlier, their lowest level since 2009. Japan, meanwhile, confirmed in April that it had sold $21.4 billion in Treasuries to prop up the yen, bringing its holdings down to $1.03 trillion, a multi-year low. But this isn't just about currency defense. According to a leaked directive from China's State Administration of Foreign Exchange, reported by Reuters, Beijing is actively redirecting its reserves into strategic commodities not priced in dollars and into bilateral settlement instruments. This isn't portfolio diversification, it's monetary self-defense, a hedge against a collapsing trust model. The result: a structural buyer is walking out the door. And if the $1.88 trillion in foreign demand starts turning into liquidation flows, then the next Treasury auction may become a global test of America's credibility. The backup plan? It's already been tested once, but using it again could ignite something far worse. On April 4th, minutes from the Federal Open Market Committee revealed that several members discussed the need to maintain balance sheet flexibility in case Treasury demand continues to falter. Translation: quantitative easing is back on the table. But this time the backdrop is nothing like 2020. Back then, the Fed was pumping money into an economy facing deflation. Today, it's battling inflation that refuses to yield. The Fed's balance sheet currently stands at $7.8 trillion, still well above pre-pandemic levels, and if it has to start buying Treasuries again, that figure could blow past $9 trillion by year-end if auctions start failing. Former Credit Suisse strategist Zoltan Pozsar put it bluntly: reintroducing QE in an inflationary environment is like pouring gasoline on a smoldering fire. And markets seem to agree. Gold soared 6% in April, breaking $2,380 an ounce, and the U.S. dollar index dropped below critical support. If the Fed restarts QE under these conditions, it won't look like a rescue, it'll look like surrender. And that's when an even deeper question emerges. What happens if investors start treating the U.S. dollar like an emerging market currency? In 2025, former President Trump launched a sweeping expansion of tariffs, targeting over $88 billion worth of Chinese electric vehicles, rare earths, and semiconductor equipment, all meant to reinforce U.S. dominance. But according to Bloomberg Economics, the move may have triggered an unintended financial backlash. Following the tariff announcement in March of 2025, China retaliated with a 34% levy on American goods and began offloading U.S. Treasuries at the fastest pace since 2018. Between February and April, China dumped $46.3 billion worth of government bonds. At the same time, trade flows took a nosedive. Data from the U.S. Census Bureau showed American exports to China plunged 29% year-over-year in Q1. That collapse in bilateral trade automatically reduced the dollar flows that had long helped to finance U.S. deficits.
Rather than isolating China, the policy appears to be isolating American debt from global buyers. On CNBC, economist Mohammed El-Arian warned that weaponizing trade is accelerating de-dollarization faster than U.S. policymakers ever anticipated. So while tariffs might score political points domestically, they also seem to be speeding up the very decoupling the U.S. can't afford. But if foreign buyers vanish, can the U.S. really fund itself alone? Gold has surged 22% since January, reaching $2,380 per ounce by mid-April. And this time, it's not fear driving the rally. It's the behavior of central banks. According to the World Gold Council, official net purchases of gold hit 290 metric tons in Q1, up 45% year-over-year. Leading the charge, China, Singapore, and Poland. What changed? These buyers aren't reacting to short-term market swings. They're methodically replacing their dollar reserves. In a March report, Goldman Sachs described it not as hedging, but as a strategic reserve rotation. The message is clear. While Treasuries yield 4.9%, inflation-adjusted returns are close to zero. March inflation clocked in at 4.2%. Meanwhile, gold offers no yield, but growing confidence. Why? Because gold isn't subject to congressional debt ceilings or central bank credibility. William White, former advisor to the Bank for International Settlements, put it bluntly in an interview with Reuters. The system is shifting toward assets free from political risk. The gold rally isn't speculative, it's structural. So the question is no longer whether gold competes with treasuries, but whether it's replacing them as the global reserve benchmark. But if foreign buyers vanish, can the U.S. really fund itself alone? Ray Dalio, founder of Bridgewater and renowned historian of debt cycles, issued a warning in April. The United States has entered Phase 5, the stage before internal restructuring. In his latest report, Dalio noted that total public debt now exceeds 124% of GDP. Interest payments alone are projected to reach $1.12 trillion in 2025. For the first time in modern history, surpassing defense spending. According to the Congressional Budget Office, interest payments will consume 18% of federal revenue by 2026, up from just 9% a decade ago. Dalio argues that this toxic combination, high debt, negative real yields, and deepening social polarization, has always preceded major regime changes. Some will argue that the U.S. still enjoys the exorbitant privilege of issuing the world's reserve currency. Dalio's reply is stark. That status doesn't prevent decline, it just delays recognition of it. The real question isn't whether a reset is coming, but whether it's already started without anyone daring to say its name. Because if the U.S. can no longer refinance its debt at reasonable rates, the only alternative may be to let inflation quietly erode it. But if rising prices become the only escape route, what happens to the people and institutions holding that debt? As foreign participation in Treasury auctions continues to shrink, China now holds just 3.1% of U.S. debt, down from 7.5% in 2011. The burden is shifting inward. National banks, pension funds, and even the Federal Reserve are now stepping in to fill the gap. According to the New York Fed, U.S. financial institutions currently hold $4.6 trillion in treasuries. If the trend holds, that figure could surpass $6 trillion by early 2026. But that creates a dangerous feedback loop. Banks are buying treasuries to meet regulatory requirements, yet when yields rise, bond prices fall, weakening the value of their portfolios. The collapse of Silicon Valley Bank in 2023 was an early warning. It lost $15 billion on illiquid treasuries, and the system buckled. Now, imagine that same risk playing out system-wide. A sharp spike in yields could trigger massive accounting losses, leading to cascading liquidity crises. In its April risk report, JPMorgan cautioned that a sudden revaluation of sovereign debt could eat into bank capital cushions. And if these banks become both the last buyers and the first casualties, then the U.S. financing system is beginning to cannibalize itself. And what if the next buyer of treasuries isn't a nation, a bank, or even a human? That's when things get truly unsettling.
As Washington struggles to attract international lenders and domestic banks hit exposure limits, a new player is quietly emerging. Firms like BlackRock and algorithmic trading giants such as Citadel and 2 Sigma are experimenting with tokenized debt, programmable money, and smart contract settlement systems. These aren't experiments, they're contingency plans, a parallel system where U.S. debt would be priced and traded in real time. No loyalty, no diplomacy, no safety net. So ask yourself, what happens when the U.S. government no longer sets the terms of its own credit? Because this time, the mass sell-off might not just be a warning, it could be the end of permissioned finance.
Thank you for watching this video all the way to the end. Your time and attention truly mean a lot. If you found this analysis insightful, informative, or thought-provoking, make sure to give it a like and subscribe to the channel. We're just getting started. More deep dive investigations and breakdowns like this are coming very soon. Stay curious, stay informed, and I'll see you again in the next video.